Yeah.
Yeah, no cleaning. That cleaning, that was it.
But that's what they do. So what they're having to do is pull the routes one by one. And then they're having to manually add fresh ground beef to from the it might do it, you just don't know how. And take the take out of the office.
Still in office.
My first name is Carol, my middle name is Rick.
I know, and I know, yeah, she's like, she always has right. Yeah, she does a lot of singing.
Oh, yeah.
Well, I'm gonna apply tomorrow.
Everybody does this every day.
Just that everybody else, the rest of the world.
Everybody, yeah, they were using that.
Bringing up, you didn't go up over the they're trying. So I said Friday, I have a little open. I got to bring how when they're able to it's still right somebody else
We worked it out.
Things are so, and I don't like the stage when you don't know.
So anyway,
I always have to sit on it. I gave you it. Okay, see, I touched.
We can get our. Yeah, of course, I
Teacher needs to know your network. Yeah.
It's hard to tell us what it is. It's more than waiting to but she's it's within there. So I told her, Sherry, on the museum, she wants
It's kind of money in the water.
and the vulnerable. People are calling. So I'm calling that. It was the first month. So you knew what it was.
They're looking at me.
Solution. When she told me, she said, you're not the first person.
Yeah, man.
Every year, it's
The water availability.
You are safe. Welcome also originally it said no, they were going to street this light. So I started 20
So I think it'll be about 3 hours to get it there.
I can't remember where I got that number.
But at the beginning, they were using this hour score. So we want to be done with it. It's fine, I don't care. But tell me, that's what they're 20 days out. That's what I was don't use the senior. Now that school has no students. So I said, we were using 27. I said, so everything is being transferred to these things here.
We need one
And
more.
I need one more.
I know Katie's gonna say that was
For Rancho. For Rancho is because it changed from 2 Saturdays. Still 98%. So
You have good news, Lou, or bad news?
Hey, man, we like to hear that.
That's one.
girls.
Yeah.
I said, man, I understand it all. Yes, one at a time. Email. I said, number 2. First, dressing. Because then I'll get it. But I'm going to email all this. I said, man, I don't have time necessary. I don't have time necessary. So I don't let this. If it's trying to, hey, but I'm going to send it. So talking about the parent, still member. So I said, yeah, I understand. So if you can do that, that would be fun. So then I said, you see if that's super. She has to go with my role. So there's this was
And then they got,
Then she got it. It was the click. And after that click,
Katie just texted, she's on her way. She has to go sit up for the banner before she gets.
you know, had a lot to eat. I said, and she was like, I've never since I explained got home at that
We're gonna go ahead and get started. If you decide to roll, we can do that. First thing on the agenda is approval of the agenda. Is there a second?
Hey, I'll check it.
All those in favor? Aye. Opposed? The next item is approving the minutes.
I made a motion to approve those minutes. Sure, and I'll second that too.
We're on a roll. All those in favor? Aye. Opposed? Next item on the agenda is financial report from Mr. Fontaine on group health.
Good evening, everybody.
And thank everyone for changing the date of the meeting. Mr. Fontaine had conflict, so we appreciate your changing.
So I'm going to go over all of the information, plan, performance, and reporting for you for the period January 1st through June of 2019 here. And if we get started right on page 1, this is the total summary of it all, and then we'll get into greater detail. Everybody got a copy here? Mm-hmm. All right. So we'll notice that up at the top, participation-wise, not much of a change there, actually less than 1%, so nothing to really speak of from a participation standpoint. I'll get into a little more detail with you with regard to participation, because a couple of things occurred this year. we have some migration to Blue Saver, which is good.
Great.
And that helped out some planned costs. We probably want to capitalize on that. Also, with regard to participation, we're starting to see membership creep up a little bit faster than participation. So when I talk about participation, if you remember from past meetings, participation is with regard to enrollment and the number of employees and or retirees that you cover, whereas membership encompasses all of the people covered at the plan belly button, so to speak. So you do not want membership outpacing.
I'm sorry. You said we had a savings from the Blue Saver, but you didn't give us a percentage.
I'm going to get into that reporting.
I'm just trying to keep up.
I have all those
All
figures.
right, all right.
And so
You had started.
memberships, once again, is the number of people, whereas enrollment is based on participation. So I'll get into those details with you. From a total claims standpoint, you can see that we're at 23,526,000, and obviously we're covering slightly more people, but you can see that we have less claims here. If you double that $23 million figure, obviously we're less than the 50 million from the previous year. I have the actual percentages for you when we break it down on the next page. Our plan reimbursements are up substantially. Most of that increase is coming from increased rebates on your prescription drugs that we had negotiated over the last year, and then once again this year at renewal. Our retiree drug subsidies are about staying the same. Total net claims of 19,939,000, far less than the 45,484 we had the year before. Fixed cost at $1,009,000. So then we take into account our retiree premiums with Humana. Our total plan cost at $22,316,815. Obviously far less than the $49,906,000, and we were covering less people. So when we take into account all of this with regard to our funding, okay, you'll see that through the month of June, we've actually developed a surplus. Our plan cost is at $22,316,000. Our funding is at $25,010,000, and leaves us with a surplus of the $2,693,000. Our budget loss ratio, cost versus funding at 89.2. And that all bodes well for the plan performance. Now when we go to the next page, this is our measurement on a per employee per month basis. So this takes into account the increased number of in our enrollment and our membership, and it puts everything more on an apples to apples basis. So you'll see in the bullets at the bottom, when we look at the participation here from the 5524 to the previous 5484, that's a little less than 1% increase, so not much of an increase in overall participation. Our medical claims are down some 5.5%. Reason being a decrease in high-cost claimants, predominantly less cancer. Okay. If you remember, the increase last year was from that, and you're going to see in the reporting that our inpatient numbers have come down as well as outpatient. Most of this cancer treatment is on an outpatient maintenance chemotherapy. The large claimants have all had their treatments of inpatient and things like that. Prescription drugs down 9.2%. This is largely due to the saving strategies and contractual discounts that we implemented on 1/1. Our total plan cost down 11.2. Total plan cost when we consider employee contributions down 15.2. So the system's cost after employee contributions down 15%.
Then before you go any further, this is all through June, and we had our increase July 1.
Right, I've got some updates for July for you, okay? Now remember, July last year, July this year, July next year, July is always a
Always
bad
high.
month. Okay, that's gonna be a high month. I can tell you that through July, we're still at about a 5.5% decrease, but that 5.5 will go right back up once we get past our summer months, because a couple of things take place. The new benefit structure takes place on July 1st, okay? That's gonna be some savings. We're also seeing more choice towards that Blue Saver plan, people moving from enhanced down to basic, things like that. Also, the prescription drug rebates are going to continue to increase. So also, the other factor is any of the large claimants that do hit that specific reinsurance towards the rear end of the year are no longer spending your funds. That's going to be reimbursed by reinsurance.
So you all told us at one of our meetings last year that you were going to do an education program. I don't know if it was for Blue Saver or for Matt's program.
That
Has
is
that been
taking
done?
place, and with the figures that I'm reporting to you today, part of our discussion is to even ramp that communication up even more.
So
The
you
more
have
folks,
started that.
obviously, we get towards that Blue Saver plan, the better off we're going to be. And the same thing with the Medicare Advantage. On page 4, this is just for comparison's sake. Basically, I'll point you to, you can obviously see that the high month is July. Last year, we had a $964,000 deficit in that particular month. But it'll come right back, because that's when all our elective surgeries are. If you go to page 5, once again, I told you that your participation had increased about 0.7%. At the same time, membership on the next page is up about 1.2. Not anything to be seriously alarmed about at this particular time. We're not talking about membership outpacing participation in a large way, but we need to keep track of that, because you guys have not made a premium increase or had a premium increase since July of 2017. So as your plan does not have increases and other employers around here have increases, maybe some of these spouses and children start becoming covered under this plan, whereas they might have been in an alternate plan previously. So it's just something to monitor. We're not having a big problem with it, and that shows up on page 7 here. Many
Page
of my
7?
school systems, I can tell you, our spousal claims figures are anywhere from 30, 40, some of them over 50% higher than the active. You're at 7% this year and 2.8 on a 3-year average. That's why we monitor these demographics so much, to make certain that we're addressing that properly. How do you address it? Some cases have incorporated spousal surcharges. Some cases will put more of, if there is time, if and when a premium increases on the table, that it's weighted more on the dependent side than it is on the employee side. So there's several tools that the industry has to curb that.
So
I'm
you're
not
looking
saying
at
we have
that
a
now?
problem with it, I'm just saying we're monitoring.
So you considering that? Is that
No,
in the
not
forefront?
at this
All right.
particular time. It's just something, if we got to a point that we were spending considerable dollars more on dependent spouses, there would be things for us to look at that the industry offers from a contribution standpoint, from an eligibility standpoint, not to move anybody off of the plan, but to increase their contribution in it to cover those costs.
So what
None of that
number,
being
you
discussed right
you
now.
said we were 3.8 on a 3-year average for spousal.
2.8.
2.8. Where would we have to get to for you to have some concern
Yes.
about increasing?
And 15%.
So we're far away from that.
Medical claims on a per employee per month basis, once again, down that 5.5%. If you'll notice the second bullet, we actually had one more member over 50,000 than we did in the first 6 months of 18, but the spend is far less, 4,233,000 versus $4,818,000, about a $600,000 savings there on our large claims. I'm real pleased to present prescription drug numbers to you here. We have gone down 9.2%, and this is from utilizing the cost-saving strategies that we implemented over the last couple of years, and especially this year with the increased discounts, increased rebates. You'll see that incorporated in it.
So you continue to use RX benefits and
At this particular time, and we constantly monitor that, and we're constantly, just like shopping reinsurance and shopping all of the other lines of coverage, we're gonna constantly negotiate on that. That's an ever-changing world for prescription drugs. I'm gonna show you some reporting in here where you're gonna see that basically about 2% of your prescriptions are driving about 30% of your costs. Okay?
But isn't it an anomaly for us to have a decrease in prescription costs? I mean, how many of your clients?
Most cases are having, the trend in, for prescription drugs is, and running in the 10 to 12% range, increasing every year. Many cases are now starting to adopt some of the saving strategies to flatten that. Yours is actually coming down because we've adapted a number of them.
But couldn't it also be because of those high claimants who are deceased now? They're not getting those medications that they would have. Because you said there was a decrease, and it was because people died. That's how you...
Well, a little bit of that is from a decrease in the cancer medications, but that is being totally offset by really when we look at what your high cost meds are, those 2% that are driving 30%, it's basically two kinds of medications. The specialty medications, those anti-inflammatories that you see advertised every night on TV. Look at my sexy elbows and the golf tournament guy and all of this kind of thing. That and your cancer meds. Okay. Ongoing chemotherapy.
How often do we negotiate with RX? Well, how often do we negotiate with RX?
They, on an annual basis.
Okay.
So they have a one-year contract?
They have an evergreen contract, but we also renegotiate fee structure, discounts, and rebates on an
Each year?
annual basis. Yes. And actually going through some of that process right now. With total claims paid, combination of the decrease of 5.5 and 9.2, we're at 6.9 overall on our total claims. When we talk about planned claims net of reimbursements, rebates, and reinsurance reimbursements, we're at a negative 13, so a 13% decrease in our net claim spent. Now, this is your percentages and performance on the 3 plans. You can see that from the bullets at the bottom here on page 11. The enhanced plan participations decreased just slightly, okay? Your basic plan is decreased once again, just slightly in enrollment. Claims are down 2.5% on enhanced, claims are down 12% on your basic. Blue Saver, the participation increased almost 9%, and the claims are up 2.9. But it's really these bottom 3 bullets. The enhanced plan is 14.6% of your participation, 21.6% of your claims. So it's not paying for itself. The basic plan, 65.8 participation, 69.3 in claims. Almost breaking even. Blue Saver is supporting. It's 19.6% of your participation and only 9.1% of your claims. Okay. So migration to Blue Saver, communication towards that effort.
Wait, Lynn, before you move, I'm trying to... Okay, the enhanced plan, you said it's not paying for itself, right?
Right.
So what are we doing to make that even off? It's not paying for itself.
Well, that group insurance is for the whole group. And in many cases, and in almost every plan, obviously, your healthy people are gonna support the folks that are making claims, okay? I'll be 60 years in October. One of these days, I'm gonna make a claim, okay? I'm healthy right now, and all of those years that I paid in and supported other folks in my plan, that's kind of how it works. So it's the same concept there, but in order to shore that up, you would have to make increases in premium on one, lower premiums on the other, and that's impactful.
But
Okay?
don't we do that?
You could,
But don't we do that when we had an increase in benefits? And I might be wrong, I don't have anything in front of me, but didn't the enhanced plan not get the same hit that everybody else got? I'm asking, because my memory might be off.
the last time we increased rates was in
You're
2017.
talking about benefits, and he's talking about premiums.
Yeah.
Okay.
So the last time you increased rates was in July of 2017. That was across the board on an equal basis. We have adjusted benefits
Benefits,
okay,
yes.
to either make the plan more financially
Cost-efficient.
sound and breaking even, or to possibly steer towards one of the lower charge plans. And that's working for you, okay? But we still got some work to do, basically.
But I can remember a time when, y'all really pushed for everybody to get in the enhanced plan. So if we're gonna push people to get in it, it should be cost effective. You should be breaking almost even as well.
We've never done a special promotion on the
Oh, yeah, and this right here, yes, yes.
plan.
And that you guys the one that would always push for it, unless I'm getting older, tomorrow I'm gonna be a day older. But I remember that.
That was high deductible.
That's the
Matt
high
was high
deductible.
Oh, high deductible, okay.
Yes.
That's the
Y'all
blue
keep this
safe.
straight.
He did.
So give me the name that goes with enhanced, because I know high deductible. Like, I know those names, so Blue Saver is high
Enhanced is gonna
deductible.
be,
Yes.
let me go through that for you. The enhanced plan is gonna be the most beneficial from co-payments, lowest deductible, lowest out-of-pocket. It's a $950 deductible, okay? Then you have your base plan, which is in the middle, and then the Blue Saver, okay, has the highest deductible, highest out-of-pocket,
Right,
least cost.
50/50, that's the one I have, I can tell.
So, a lot of folks look at the premium structure, and if you're healthy, and they start to do the math and start to think about it, and we communicate to them properly, they're gonna scratch their heads and do the math and say, you know what, I'm gonna take a look at this Blue Saver plan, because this is gonna put some money in my pocket, okay?
And the reason we have the different plans is because of the different needs of all the
Different
employees.
ages, different, medical histories.
Family size.
You know, if I were a high utilizer, I might not be in that Blue Saver plan. If I've got a bunch of kids and I'm really into these co-payments because I'm bringing them back and forth to the doctor and I got pink stuff and the eyes spots all went along, I'm probably gonna like the co-pay. Choice is good.
I want to stop just for a second and thank our superintendent is here, Mr. Osprey. Thank you very much for taking the time.
Thank you.
Page 12, total plan cost, down 11.2. I'm gonna point that bottom bullet out to you. Since 2012, not taking into account the decreased costs of 2019. So 2012 to 2018, 6-year period, average 2.8. That's something to brag about,
That's-
folks,
That's
Yeah.
amazing.
okay?
Yeah.
If we take into account the figures from this year, that average becomes less than 1%. So if we stay on course this year and complete this year with the kind of numbers we're reporting right now, our 7-year average, okay, for increased costs is gonna be 0.8%. That's smoking. Claims by type of service, all down. If you'll notice, in the parentheses, when you're looking at 2018 versus 2019, there's the per employee per month number. Inpatient has gone from 142 to 120, That's a 15.5% decrease. 148 to 145, only 2% for outpatient. Remember, that's where the chemotherapy is going to. Professional, down about 14.2. And of course, the prescription drugs down 9.2. You're looking good in all areas of your plan. It really points it out on an inpatient basis, and on page 14, look at 2018, and the third diagnostic category is neoplasm, which is cancer. You expended $19 per employee per month for the 2018 plan year on neoplasm on an inpatient basis. That has dropped to $7. Okay?
Wow.
If you went through all the other categories here, we're down slightly on musculoskeletal, we're down on circulatory, we're up on injury and poisoning and pregnancy, okay? But we're significantly down on that neoplasm, 68%.
So what you think attributed to that?
Well, last year was an anomaly as far as the number of high-cost cancer members that we had going on, and if you remember, that's where our increase in cost was coming from. I said it's probably going to decrease because as you go through the continuum of them, rest their souls, some of them have passed, some of them are in remission.
We're also not seeing
Diagnosis on
additional
an
cases.
outpatient basis.
We're also not seeing additional cases of people being diagnosed.
You're always going to have a number of them because cancer being so prevalent, and especially in our area down here.
But not to
But
the
last
extent
year
of
was
what
an
we had.
abnormally high. On your, as much as it shows you in the inpatient, you see it again on the outpatient because neoplasm is equal to where it was. It was 28 last year, it's 27, but this factors influencing health does include maintenance chemotherapy. Top facilities, more good news to report to you there. Lafayette General garners our deepest discounts through the network. Okay, you're not seeing any Ochsner during this period, and everybody else's numbers are far lower because you've had such lower utilization on an inpatient basis. So better mix of providers and deeper discounts mean lower numbers. At the same time, we've creeped up 1% on our prescription drug utilization, and I told Ms. Mona 87%. You know, we can always get a little higher, but that is certainly not a bad percentage, especially with the degree of retiree participation you have in your plan, and where, you know, a number of medications might need to be brand name. At the same time, if you look to the next page, not that it's disappointing, even though we keep taking more generics, those high-cost meds that we talked about a little earlier offset that, because 87% of your medications being generic only represent 14% of your total spend. So if we flip the coin on that, 86% of your cost is coming from 14% of your medications. I'm pleased to tell you that utilization's going down a bit. You can see that we peaked in 2017 at 3.1 prescriptions per employee per month, or 1.8 per member per month, and we're down to 2.8 and 1.6 corresponding. Your top 10 medications by number of scripts. This report really looks good because it doesn't have the kind of things that some of the others do. You don't have this higher utilization on some of your ADHD meds, things like that, sleep meds, things like that. This is all antibiotic, high blood pressure, thyroid meds, things along those, and all of that maintenance type medication that you hope your employees adhere to, and that's all in that generic category. Turning the page, and you'll see that first bullet, 2.1% of your total number of prescriptions, 29% of the total cost. Other than the second medication, which is a blood thinner, okay, all of these are either a rheumatoid arthritis, psoriasis, Crohn's disease, anti-inflammatory, and that's the Humira. That is also the Consentix. And then you have the cancer meds, which are all the anti-plastic agents there. Still in all, even though that number has come up a bit, we're still dealing with a 9.2% decrease in overall prescription drug costs. 70.5% PPO discount reported on the next page. Why are we talking about Blue Cross, and as far as this past year's contract, they're offering us the deepest discount? Okay, from a fixed cost standpoint, they remain competitive. The way that we can get deeper discounts is we would have to go out and create our own network and convince some of these hospitals and doctors to take a percentage over Medicare. As spread out as your retirees are, we're constantly going to be taking a look, because these types of contracts are becoming more prevalent in the market. But is it ready for the whole group? Not at this particular time. We're watching it. We're still probably best served on a carrier model network, and Blue Cross remains to have the highest discounts in their area.
And you're in the marketplace, just because this issue came up before, you're in the marketplace all the time, not just when the contract is
You
due.
have to be. I mean, you've got a $50 million plan. If we're not shopping different services through it, we're not doing our job. You've got to do that. So, from a network utilization standpoint, we dropped from 98.4 to 97.5. It was some out-of-state rehab, nothing ongoing. You're not moving along, you're still doing quite well with your in-network utilization. And the 70.5 measures the degree of the discount. The 97.5, which I'm sitting in a room full of educational people, I think that's an 8, okay? I do remember when I was schooling, if I made a 97.5, I might have got a gold star. But at any rate, that is good in network utilization, so you're doing good there. Then we talk about the cost breakdown. You want your fixed cost to remain as low as it possibly can. And what is the fixed cost of the plan? That's paying Blue Cross to administer the plan, and that's purchasing reinsurance. So reinsurance being some 1.8% of your total plan cost, administration running at 7.1. That means that over 90 cents on a dollar is dedicated to claims. That percentage came down a little bit because your claims came down, not because your fixed costs went up. Okay? So you're running your plan very lean. Plan costs net of employee contributions down 15.2%. That's beautiful. And then when we talk about high cost claimants being the driving force of plan costs, whether it's going up or down, it's not always, but almost. I mean, probably 90% or more of the time when you see an increase or a decrease in a large, partially self-funded plan, the first place to look is on high-cost claimants. Reason being, if you look at the second to last bullet, if 10.6% of your plan members are responsible for 83% of the total cost, high-cost claimants rule. Okay? So in this particular period of time, you've actually had less, over 200,000 in number of members, 4 versus 2, but it's $861,000 of savings That's the big number where we've got decreased costs. So let's talk going forward. We know that our new benefit structure implemented July 1st. We know that we've got these continually increasing prescription drug rebates and our utilization's looking good. We get past the high July month that we're typically going to have each and every year. I'm going to tell you July's going to be high next year as well, folks. But we're doing well, and it looks like we'll continue throughout the year, showing some planned savings, because even through the month of July, we're still significantly under last year. So happy to report that, and we'll just continue to educate and negotiate.
Any questions for Mr. Fontaine?
So if these trends continue, we should not need an increase in premiums or a decrease in benefits, correct?
If we continue at this clip, I would say everything's pretty
Should
sound
be
better
okay.
this year.
All right, thanks.
No more questions. Thank you very much, Mr. Fontaine.
Thank you.
Mona, you're up next.
Yes, ma'am. Update on contracts. We're going to address that a little more in the next section. We do want to update you on some issues with life insurance that EDI was able to work through and to our advantage, so we want to share that with you. The COVID administration, what was your question on that?
Yeah, there was a question brought up about how COBRA was paid, whether it was by fees or not fees.
COBRA is billed by Acuity, the Acuity Group. They do send out the bill directly to the person who's elected COBRA. They do charge a 2%, you're allowed to charge a 2% fee over the premium, and then they remit the premium back to us.
So the question that was raised by the Andrews people relative to how COBRA was paid was a non-issue?
As far as I know, I don't call it being an issue.
In your contracts, the ones that you give us every meeting, there's no changes in any
No
of those?
changes. No.
Anything else, Mona?
That's it.
EBI, Mona, excuse me. I think, yeah. and-
I signed them
You
in.
signed them in?
Yes,
Okay,
I did,
thank
as
you.
you came in.
Did you forge my name?
I did, but I put a little initial RV next to it so that I know.
Listen, you can come to school and sign all the checks.
They're recording the meeting, so we'll have it. We'll know who's here if there's any doubt.
That's it.
Oh, yeah.
Yeah,
Here,
yeah.
Joe.
This is good. I get to follow that because he throws all those numbers.
No, this is Lynn.
Okay.
This is good numbers of that. This one is so we have
Just, I'm an officer, I'm here for the group. But when we have a surplus, you know, when there's money left over, right? From the premiums that the employees and their people that are on the and all claims are paid up. What happens to that surplus?
Well,
Really?
in this case, because the report is from January to June, our biggest claim I think is July. So the surplus, what you see is the surplus now, we're likely not to use the surplus at the end, which is why. I'll tell you what I'll buy.
You're right, that's how. Oh, there you go.
That's more to rate so it's a question is it back? Or is our government just pay back? It just stays even longer. But generally,
And it rolls to the next year.
yeah,
To pay claims or whatever.
in the plan, or administrative costs, when it doesn't leave the plan.
All right, we ready?
Yes, sir.
It's good to be with you guys under these conditions tonight. It's good to be able to come and know that it's time for us to partner with this committee and obviously with Mona's office to do what we can to help the employees and the retirees of LPSS. And we look forward to continuing to do that moving forward. Things are going really well. Tonight, what I really want to do is I want to focus more on renewals, things that are coming up for that 1 year, the products that we brought in, any rate changes, anything like that. And then we'll talk a little bit about open enrollment. And I haven't figured out, John's got a couple of things that he wants to introduce to you as it relates to opportunities for retirees and life insurance, home health care, some things that we felt like we might be able to be creative with and bring to you guys to consider. So what we'll do is we'll start with renewals, and what I'm going to do is I'm going to go through each of the carriers and the products that we have in the group under that carrier, and I'll tell you how they're coming back as far as renewals. Lincoln has your short-term disability, they have your long-term disability, and they have your critical illness. All of those are rate holds, okay? The Lincoln is in the middle of a 2-year rate guarantee, so we won't need to worry about that until next year, and hopefully they'll come back with a rate hold. I think the employees really liked what we brought in as far as how the disability
Repeat that for me. You said short-term, long-term?
Short-term, long-term, and critical illness. It's a plan that pays a lump sum with heart attack, stroke, that kind of thing. So.
And these are all voluntary benefits?
Yes.
Yes, ma'am.
Yes.
And what's your name, sir?
I'm sorry, I'm Shane Pennington. You don't know that by now? Go on, Miss Carol, I know yours.
I'm getting older.
I almost, some of y'all got here early, and I walked in without my jacket on, and I got to looking around, I was like, golly, I gotta put that jacket on. I was thinking, have I not made a good enough impression yet? But
I remember now.
so, if you guys give me permission, maybe I'll show up with no jacket next time. Probably not.
Here, yes.
Trustmark. Trustmark takes care of your universal life. They have a really unique product. It's universal life, and then they have what they call universal life events. And that particular plan comes with a long-term care option as part of it. I won't get into the details of that because I know that you guys have communicated that you'd like for me to come back and maybe focus on a product each time and talk about the details of that, but I won't do that tonight. And then they also have your accident policy. Those are all rate holds as well. There's nothing there. As a matter of fact, the Trustmark plan that we brought in, we're still going to be able to offer a guaranteed issue that is guaranteed issue this year for people who chose not to do it last year. So they'll be able to get up to $60,000 with the universal life that Trustmark offers. Unum Life Insurance, they're all rate holds. I will tell you that there is more, like Mona alluded to, there's more to talk about as far as Unum. I'll bring that up later, but that is a rate hold right now. So that's going to be the basic life. I want to talk about that. There's a little bit I want to talk about the supplemental or the voluntary piece, but we'll do that a little bit later. And then we brought in a Guardian cancer policy, and that was also a rate hold. Your folks really liked that plan. We were able to not only be guaranteed issue, but for any folks that had a previous cancer plan, if they moved over to the Guardian plan, they picked up their claim. So if they were receiving payment on another carrier, they can move to the Guardian plan, and they agreed to pick up the claim. So that's kind of a special situation, but we were happy to be able to service that. Superior Vision was a rate hold, and then Dina Dental is the one where I will slow down, and inside your folder here, you've got a bunch of numbers. I may have to start referring to my numbers as Lynn numbers, because I know Lynn comes in with a lot of numbers. So everybody on the left side, you're going to see a spreadsheet. I don't want this to get confusing, so I'm going to try to make this as simple as possible. First of all, you currently are with Dina Dental, okay? Skip has actually been a part of this school board before, and he supported Dina Dental when you were here, correct?
Correct.
So in working with Dina, last year, that was one of the plans that we made a decision. We said, you know what? That plan is under a 2-year rate hold right now. We need to take advantage of that. Retirees are covered under that plan, and really, to be honest with you, we didn't want to do anything that was going to disturb any of that. So really, the main reason was because it was under a rate hold. Well, the rate hold is up, and what they've done is they come back with a 7% increase. Now, nobody likes to see increases on anything. So what we did, first of all, I spent some time with Doug over at Dina, and I said, you know, you've worked in this school with the school board for some time now. What's going on with this particular plan? And he shared with me that the previous broker had asked him to change the plan design some, and he feels like the plan design is the reason that it's not running as well as it should be. Dental is one of those things that once you get it running right, well, you don't want to move it because if you ever get off balance, and it becomes unstable, you could see 12% increases, you could see even higher than that. It's very unlikely if you've got an unstable dental plan to see any decreases. So it's usually going up, and that's typically the trend. So I spent some time with him and I said, what do we need to do? And he said, we definitely need to make a plan design change. And I said, okay, so when the renewal comes up, I want you to give me two different options that we can review as far as plan changes. And then I'll share it with the committee, and then we'll decide which way they want to go with this. So what I want to use as a baseline is what Dina came back with. And then I've got a couple of other carriers that also submitted a bid on this, and I'll show you where they are and how they're a little bit different. So on the first page, that entire first page is basically a comparison of your current plan. So no plan design change. So basically, if you see there in the green, that is the current Dina. In the bluer shade, that is what their proposed 7% increase. And then over to the right, that's Delta Dental. Now, one thing that you'll notice with them is that they did not feel like it was good. There was too much risk to keep the active employees and the retirees at the same rate. So you'll notice there at the top where it says Delta Dental, you'll see high active, high retirees, low active, low retirees. I'll tell you up front, I didn't really care for that. That's not how I asked for it. That's how it came back. So if you look down here, you already know that Dina came back with a 7% increase if we didn't change plan design. If you look at Delta, they actually gave you only a 3% increase on the active high plan. But as you look across there, you see the high retirees, there's an increase there. It ranges from 5.7 up to 11.7%. And then you look on over to the low active, and this is where they really wanted to hit, because they felt so strongly that the plan was so out of balance, and it's because of the low plan. And I'll explain more of this as we go through. But you can look across there, 25% increase for low actives, and even bigger increases for the retirees on the low plan. So let me stop right there and remind you of what we've got as far as retirees. So we've got an old indemnity plan. Is any retirees that are here, are you on the old indemnity plan? Do you remember it or not? So there's 84 people, 84 retirees that are on the indemnity plan, okay? Then you guys somebody made a decision at some point that indemnity plan would be a closed group. So nobody else would get on that plan. And then any future retirees would go to the active, low, or high, okay? I don't know if you guys remember when you did that or not, but that's the current case. That's probably so. It was.
When was it done?
I don't know, it was a condition of renewal, I'm sure.
I don't think it ever came to the committee.
Okay. So basically, it's probably a good thing. Whoever made the decision is probably a really good move, though. So basically, you got that group, and then you've also got one group that is on the same plan as the active low and the active high, okay? So that kind of gives you an idea of where, if you stay with the exact same plan, where you're going to be, okay? Any questions there before I go to the first option that I call it option 2, okay? Second page.
I think one thing is, does everybody understand the difference between the low plan and the high plan as far as benefits go?
I don't.
It's not in a typical dental situation where you have what's called a dual option. I've got option A and I got option B. I got a high option, I got a low option. In that situation, you try to typically make a big distinction between the low plan and the high plan in both benefits and premium. So that people that really don't want to spend that much money or $30 on a dental plan, they're okay with spending $15 to $18 on a dental plan, and they're willing to do without having a crown, because they may just get their tooth pulled. I'm not going to get a crown and spend $700. I'm just going to have my tooth pulled. That's their choice, and that's why we like to do a low and a high plan. Y'all's low and high plan is really close. They're not that distinctly different, which means if it's me and I'm looking at the low and the high plan, there's really not a lot of difference in the plan design. I'm going to go with the low plan because the premium's better. And that's what's happened. The cost difference is pretty dramatic. You look at 18 versus 34, and if you look at it, the difference is a $1,500 maximum versus $1,000 max. Well, a lot of times, most people don't ever hit $1,000. So that's really kind of a negligent. It's really not that important of a benefit when you have a high max.
But the premium is.
But the premium,
shocker.
and what you've done is you've
That's exactly
driven
right.
all of the people to the low plan because they understand finances and it makes sense to do it. The problem is they're using it, the premium isn't really accurately reflecting the benefits.
So basically, right now, you guys have 1,550 active employees on the low plan, 731 on the high plan. So that kind of goes to what John was just talking about. We've been driving people, or the plan that you have right now is driving people to the low plan, and that's just not the way to have it built.
The premiums that they're paying, they're making the right choice for them, for the benefits that are offered, but the premiums are not supporting the benefits that they're paying.
Which is the cause for the increase.
Correct.
That's it.
The issue is when they went high option, low option, there was not enough separation benefit-wise, and that's what created this right here.
And from the standpoint of what I'm looking at on the front page, if I'm in your shoes, and the first thing that we're gonna say right off the front, we are a broker. We want to do what y'all want to do. We can stay with Dino, we can go to Delta, we can look at another. It does not matter to us, but our job is to make sure that we give you all the information so that y'all can make an informed decision that's in your best interest. So know that we'd have no dog in this on which way we're
Do
going.
you have a difference in condition?
No,
it's
same.
all the same.
They're both the same. It's a standard commission with both Delta, Dina, and Lincoln.
Standard being what?
Standard commission is 10% on voluntary dental. And so,
I said, oh, if I to present that to retirees.
Oh.
down at Fix
Yeah, that
It.
wouldn't be fun.
and that's what so my initial thing here is, I'm out on the Delta Dental, on this option. That does
I
not,
don't like it either.
I don't know, I'm not gonna move for something that's gonna cause that much disruption.
You know what I'm thinking of? I'm thinking of custodial workers, cafeteria workers. Then, it's something else coming out of their pocketbook that's already nothing in it.
So
We're on the same page, we agree.
So let's move forward to the second page, and I called that option 2. You'll still see there on all these pages, I put the current plan so that you can compare to it. So now if you move to the right, you see the blue Dina Dental. Really the only thing that they changed here on the plan was they moved the basic or regular restorative services from 60 down to 50%. That's pretty much all they did there. If you'll come down to the bottom, that is actually that shows you what is covered on the indemnity plan. And then what they wanted to do was, you've got ortho. Your retiree indemnity plan has ortho, child ortho in it. It should have never been there. So, because it only goes up to 19. So you really didn't need it. So it's there. So what they said was, well, we would like to move those people that are currently in that indemnity to a PPO plan that has the same coverage minus the ortho. Okay. And then the next thing that you're probably thinking, well, Shane, if we're taking ortho off, then why are they wanting to increase it by 3%? So again, all these guys are trying to build a plan that gets stable. It's not stable right now, and they all see that. As a matter of fact, the other carriers, Delta and Lincoln, they all said that a 7% increase was really kind of generous. They felt like it really could call for a lot more than that. So on the Delta plan, I'll go ahead and show you, they didn't change the 50, they kept the 60%, so you're not going to see any changes in premium or anything there. They did, if you see at the bottom here, they wanted to do the same thing to move them to a PPO plan. They removed the ortho, and you'll see a small reduction or decrease in their rates there. So from the 28.90 to 28.71.
That's just as to the 84.
Yeah, just to the 84. Sorry, that bottom piece is just for the 84 folks that are on the indemnity plan. Okay. And then let's go ahead and turn to the third page, because everyone that we spoke to said this is the direction that we need to be going. As John mentioned, there needs to be a big distinction in coverage between the high and the low. There needs to be a pretty big distinction between what you pay for the high and for the low. Why? Because you really do. You want to drive people to the high plan if they need the high plan. You don't want to give them an option where they can say, well, I need all those things, but I can get that on the low plan. I'll just pay less and I'm still going to have the opportunity. So if you'll look here, you may think that this is drastic, but I think it's creative, what we asked them to do. And you'll notice that Delta did not give me a quote here. They said, I do not want to quote that. Okay. So you'll notice that Lincoln took Delta's place on the third page. Lincoln didn't want to do either of the first two options. They only wanted to do this option because they thought that that would be what would be most healthy for the group. So here's what it is. Basically, you've got your basic coverage would go from the low plan would go from 60% down to 50%. And then we would remove the major services and the ortho from the low plan. Okay? If you do that, then Dina says that they're going to hold your high plan rate, so any retirees and any active employees, they're going to hold your rate, and then they're going to reduce the cost on your low plan. And you can see there's some, it's not a straight 6% down the line, there's differences there. And it's not a huge decrease on the employee one and family, but still there was decrease. What Lincoln did was they said, we'll give you 4% decrease on the high plan, and we'll give you a total of 6% decrease on the low plan. Okay? So that's in comparison to an identical plan to Dina on this third option, if you choose to make this change to your plan design. The other thing is, down here on this retiree indemnity plan, Lincoln jumped in there as well. So where Dina was going to give the 3% increase, Lincoln agreed to hold the rates for those 84 people that had an indemnity plan.
But all those remove ortho from,
That is correct. So yes, so even on that second plan, on the indemnity plan, they removed the ortho. On the active, so the top bar on option 3, on the low plan, it would remove your major services, which include your endodontics, your periodontics, your oral surgery, and ortho. So what that does, and we have some active employees here, so we can talk about this, but what that immediately does is it says, do I have anybody that needs braces or anything?
But oral surgery is a different animal.
So again, we're always when we're talking about insurance, we're talking about how much risk we want to take. Have I had the last 10 years of my life, have I had any cavities? Have I had any issues? Am I willing to take the risk to go to the low and save that much money? Or if I've had issues, then I need to move to a high plan that I make sure that I cover all of those things. So the other thing that I need to make very clear here is the difference in rate guarantee. Okay, so Dina, they're going to give you, they're going to hold your rate on the actives and retirees on the high plan. They're going to decrease the low plan by just a little bit, and then they're going to give a 3% increase on the retirees that were in that indemnity plan. They're going to give you a 2-year rate hold. Okay, that's something to consider. Different than that, and a different way to look at it, and we can explain this. Lincoln said, well, we'll give you the 1-year rate guarantee, and then after 1 year, we'll give you a cap that says that we cannot give you an increase over 7%. So now let's look at this. So if it happened, if you went with Lincoln, and then year 2 or that renewal comes up after year 1, and they say we got to give the 7% increase. Well, where are we in the net of things? So they're giving you on the high plan a 4% decrease. So really, at that point, you're only getting a 3% increase, but you've already given everybody a 4% savings up front.
Does that make sense? Because this one took me a while to look at this and figure it out. But
Good, because I was so worried that I was going to confuse everybody with that. But so, go ahead.
well, the thing about it is all I want's options.
Yeah.
Just give me some options, and then y'all figure out what makes more sense. There's always going to be disruption when we change. There are going to be some people that love Dina and they want to be with Dina, and that's what they want to do, and that is absolutely fine. There are other people, because we have heard from a lot of people that wanted to look at other things because of network.
Yeah.
Dina's network is very limited, and like I said, we're not here to beat up on anybody. We just state the
how
fact.
limited is limited?
So,
Yeah.
so right now, in the analysis that we did in a 10-mile radius around Lafayette, they have 68 access points, okay? 68 folks in their network. Now remember, Dina has a plan that says that no matter where you go, you're gonna get the 90th percentile of savings, if you will, or discounts.
And what that means, just for simplicity, because it's kind of difficult to try to grasp all these different terms, that's usual and customary charges. And what that means, most of your dentists, except the very high-priced elite dentists, will take that as payment in full. So most most dentists will take 90% and they will not give you a bill for anything else. So that's kind of what the 90th percentile does. Some people do, but if you want to go to a dentist that charges more than the 90th percentile, it's your choice to pay the difference. But that's
So in Lincoln's network, they have a total of 187 access points. So where Dina has the Dynamax network, Lincoln has the Dynamax network, so none of your folks would have to change dentists, but then they would have roughly 120 more access points for dentists that they could go to. So I can tell you, again, Dina's been great. They are the ones that said, we got to change this. And I knew that when there was kind of a false start. When we first came in, they told us, they were like, you're getting a 7% increase. And then we realized, oh, no, we're in a 2-year rate hold. So I didn't want to come in my first year and have to tell you that you were getting a dental increase. So I was glad to find that out. So Dina's been great to work with. I can tell you on the survey, and I don't know if this is a trend or not, but I can tell you on the employee satisfaction survey, we did have, and it may have only been a handful of people, but we did have some people that said that their dentist would no longer accept Dina. And I don't know, and typically when that happens, it's because they're late on payments or something like that. It's something administrative with the dentist that would create that time.
or they're not in network. They will still take 90%. They just are not in network anymore. Is a lot of times what that.
That could be another reason.
So that means you can't
So
go
why
to
are
it.
we just hearing this?
Yeah, really.
What's that?
Why are we just learning that problem was identified on the survey? You're talking about the enrollment?
The survey that we did in the
last year?
enrollment, we haven't really had an opportunity to come and visit with you guys, but there was no change that we were going to make mid-year. It's a pre-tax benefit, so this is the appropriate time to share it.
You were in the middle of a 2-year guarantee
Yeah.
when we came to the committees and the board last year. So you already had that extra year that was built in where you were insulated. They couldn't raise the rates for the employees.
But if employees had problems,
Yeah.
the dentists weren't taking it.
Yeah, and again, that may have been just a handful of folks. I'm just saying that there were some people that voiced concern with, they could do the same thing on Lincoln, they could do the same thing on Delta, but we did have some of that.
And to clarify, Ms. Mounts, on the dentist not taking the plan, the employee can always take, which we don't want that to happen, but the employee can always take their own claim and file that directly with Dina. Instead of the money being reimbursed to the dentist, the employee would pay the dentist, and the reimbursement would come from Dina Dental to the employee.
And typically that call comes into our customer service call center. And when that call comes in, we tell them, okay, let's handle it this way. Let's take care of it. We'll go ahead and take care of it right now, rather than that person doesn't get treated. That person went to the dentist and got treated. They didn't get the discounts. So what happens is the dentist say, I'm not going to take a discount anymore. I want my full 90% reimbursement. Whereas if you're going to Dina's network, or if you go to Lincoln's network. So Lincoln's network on average, when you look at Delta and Lincoln, they average about a 20 to 25% discount. So if I go get a crown and 90% means their crown costs $1,000, well then if I go to an in-network provider, then it's going to cost somewhere around $750, and then I would pay 50% and the insurance would pay 50%. That's how it works. So the difference between going to an in-network provider and a non-network provider is you could actually get some good discounts and get cheaper costs, which would save the employee their portion of that 50%, but it would also save the plan that portion of the 50%
So
too.
what is your recommendation?
I
So-
have a question before.
I
you
have,
do
me
that.
too.
Absolutely.
I want to make sure I'm reading this correctly. So whether it be Dina or Lincoln renewal, the only thing covered for low, active, and retirees is 50% of basic and
Period.
regular
And then your
services.
100% of all your diagnostics and your cleanings and all the
Root
preventative
canals,
stuff.
and you,
Yeah,
crown, I
that's
have
no
3,
longer
come
here.
on. Yeah, come
Right.
on.
And I think so let me, from a high level, and I know we got some questions too, but I think this may help a little bit. From a high level, what I would say is this: if you want to keep the plan just like it is, then we'll try to see if we can get Dina to give us any more rate relief I don't know that they can. They're pretty much where we've got them to where we've shown them the competitive data where they know they have competition out there. But if you want to keep the plan just like it is, then we would stay with Dina and we would take the rate increase. That would be the easiest.
Whether you go Dina or Lincoln, it's a drastic change.
Agreed. So option one would be going with Dina with the rate increase and the plan like it is. Option two would be going with Dina, but on the option three with the drastic decrease, because I'm used to it and I'm still saving a little bit of money and it's easier. Or option three would be, I'm gonna get some bigger savings, but I'm still taking a drastic step and I'm moving to a new provider. So that's really what you've got to weigh out is those are my three, in my mind, those are my three options. And, you know, hey look, a lot of times it's easier to keep it like it is. Nobody likes to get a rate increase.
Yeah, but I don't like option three at all because you've eliminated services that retirees still use. And then you're gonna ask me to take it all out of my pocket, and I'm saving how much? Come on, y'all.
Well, but here's the thing, so let me back up in this. So you can still, retirees can still move in, anybody can still move to the high plan. Just because you're in the low plan doesn't mean you can move to the high plan. It's gonna cost you
Twice as much.
You keep saying
It's
that.
gonna cost
We
you
understand that.
twice as much.
What can you
Yeah,
do
but it's your
to make
support
it
people,
cost
they can't afford
yes,
it.
Yeah.
cost
Okay.
effective for
They don't
everybody?
I mean, they don't get much in retirement.
I'm with you 100%. And my thing is this, we are not trying to drive you to, I mean, here's the thing is, this is gonna be a lot more work on us to educate employees to make sure that they don't take the low plan thinking that they have a root canal, gum period, or a crown,
Retirees too.
because that would
Retirees too.
create, that'd be a huge, terrible situation.
But that's retirees.
And I don't know that you can do that kind of education
No.
Well, here's the other.
effectively.
What we know for a fact is it doesn't matter how good of a job we do, 10% of the people are gonna get it wrong, and it's gonna cause a headache. Now, the problem is if we keep the plan like it is, we know that the low plan is underpriced. And it's gonna keep causing problems for the plan, but you know, at the same time, we've got a 2-year rate guarantee. Am I right, or is that on the option three?
Well, it's a 2-year.
Okay, so we got a 2-year rate guarantee, so the reality of it is, we could keep it simple and it is gonna be a rate increase, and nobody likes rate increases.
But I think you need to go back to the table, because I need you to look at the entire picture, active and retirees. And, you know, again, I'm fighting for those who are not making a whole bunch of money trying to survive on it. You need to consider them. And listen, I'm not in that, I promise y'all I'm not there, but I'm fighting for those. I have retirees, I'm telling you, those, they might be making $600 a month. And then you're gonna tell me that if this little old lady, Carol Broussard, her tooth start hurting a lot, she needs a root canal, she's gonna have to take that thousands of dollars out of her pocket.
The other
That's
option,
what you're saying.
Well,
Can an option be
The other option-
negotiate
Let's negotiate.
and restore some of these services? Maybe
Yes.
not at 50%,
Yes.
maybe 30%.
let me remind you, there is option 2. It's a very small change. It just goes from 60% on the basic to 50%. That's the only change, and that gets you a 3% increase.
I can,
So that's a possibility.
So
I
that's
can
a,
tolerate that, Katie.
Well,
You're
I
telling
just
me I
hate to
can't.
see people without services,
No.
because they're gonna
Understand.
end up with root canals, they're gonna end up with,
Yes.
and
No, I
then all of a
understand.
sudden they get this huge
What'll
bill.
happen is they're not gonna get the dental insurance.
That's right.
Well, yeah,
And then they're
I agree.
gonna, because I can tell you, like, looking at it for me, if I do with my family and I look at NA, and I say, yeah, but I'm not paying $112 a month. I'm not gonna do that. And so I'm just gonna say, you know what, we'll take our chances with dental insurance. And I am an active employee who makes a lot more than what you were referring to.
right, sure.
So,
And then
you know, when you're
without
talking
dental
about
insurance,
others,
it's gonna affect somebody's health,
That's
and
it.
then your health.
That's
Right.
correct.
that's exactly right.
I think y'all need to get back to that table.
Oftentimes, when we go in and we visit one-on-one, a lot of the folks, support staff as well as certificated employees, if they knew, and they don't always know, but if they had a crystal ball and they knew that they were only gonna have their 2 cleanings per covered family member per year, they can certainly make a case not to have dental insurance. Because it almost ends up being a wash. Where the dental insurance really becomes the dental insurance is if the person all of a sudden finds out, I gotta have a root canal and a crown and some of these major services that are very expensive. That's where the dental insurance becomes the real safety net that can help them a lot. Again, it all comes back to the risk. How much risk do they want to take? And we run into that all the time. People say, I'm going to take my chance. We've been fortunate. We've had our 2 cleanings per covered person, and those folks are comfortable going without dental insurance and focusing, like you said, more on their medical, because they can't take a chance there. Does that make sense? I mean, does that?
Yeah, I understand what you're
Can you
saying.
go back to option 2, where there wasn't a
Yep.
tremendous change?
So it just went from 60 to 50% on the basic, and instead of 7, it'd be a 3% increase.
And so I'm looking at, the current is, for the low is 18.16, and the increase would be $18.70.
Correct.
So you're looking at
Some change.
60
Yeah,
cents.
that's a little bit more acceptable.
And all of
A
those,
lot more acceptable.
and all of
So
the,
you can get that to
Still off
2%.
and when increases are discussed here, for all of the employees, whatever the increase is, 50 cents or so many dollars, all of those dollars or premiums are paid with pre-tax dollars. So this premium's gonna be taken from their check for the actives,
Yeah.
pre-tax dollars. So that takes a little edge off of the premium increase because it's coming out before taxes for the active employees.
And I do want to say something about it. Like I said, change is difficult. Making a change, especially when you've been with Dina so long, it would really have to be something dramatic for the change, but we've got to get something that looks and feels good to where Dina says, all right, I'm going to come back and lower my rates from where they started to where they got now. These are heavily negotiated rates to get them down there. There's probably not any room left. I'm not saying that we aren't going to go back and ask for some more, but at the same time, I think when you look at it, the one thing I've heard loud and clear, we ain't going with option 3.
Amen.
We're looking at option 1 and 2. I think everybody's kind of, or at least what I've heard. So then what we're looking at is option 1 and 2 with Dina, period. And so the question then is, how big of a difference is that 50% versus 60% and 40% you're losing? 10%, but you're getting a 3% increase, which is better than a 7% increase. Like I said, 60 cents, money's money, but that's not gonna
No, I agree.
sink anybody.
Is this for this coming year? We have a 2-year rate increase. So when would this go
Rate
into?
guarantee.
2-year rate guarantee.
Rate
So this would go
January
1/1 of 20.
One
Yeah.
of 20.
Three people were talking.
1/1 of 20. So this is the renewal for 1/1 of 2020.
Which is this year's open enrollment.
That's
This
correct.
fall's open
Yes,
So
enrollment.
our 2-year rate increase
Is over
is over.
in 12/31 of
Correct.
19.
Got
The rate guarantee, yes.
And then we would, if we went with Dina, whichever way,
So we had a
We would have
1-year rate
another
increase
2.
when you all came on board.
No, we were in the middle of the rate guarantee. You're saying rate increase,
mean,
rate guarantee, yes. So we were 1 year into the rate guarantee. That's one of the reasons that we didn't touch it. So,
I personally prefer option 2. I mean, it decreases the benefits just a tiny bit. It increases the premium, and I think people can accept that
Mhm.
if they're still getting the service.
Yeah.
Or some benefits, extra benefits. The other options with eliminating those benefits, I think.
Let me ask you this.
I think you're gonna have a revolution on your hands, I hate to say it.
No, I understand. But I do want to ask this question. Because I didn't tell them to build it this way, but do you think, and I don't know that I can get any more out of it by doing this, but do you think that if we left all of the major service to endo, perio, but removed the ortho from the low, because not everybody's going to need braces, not all the children are going to need braces, I could go back to them and see, hey, if we remove ortho on option 2, being a dental,
But some people
You
are
could
buying
remove it
it,
from the retirees.
some
I'm
people
not
are
sure.
buying it for the ortho.
that's why
Yeah,
they
you
want,
can add one.
but that's why we want to get them to go to the high plan now.
I understand.
Because it's hurting the longevity of our rates. and all that.
he's right. If I'm a single parent and I have a child that's in that age, if I'm a single parent, I'm paying for ortho whether I get it or not.
Right.
And that's the only thing is you may be impacting some people that don't benefit from children's ortho, or they don't want it. If they wanted, they get the other. But like I said, these are These are choices. The difference is it would only impact the employee plus one and family rates if we did change that. It would not impact the employee only rate, obviously.
It's just a thought.
And those 84 retirees at the
Yes.
bottom,
Yeah, so,
you would remove it from them?
Yes.
And you plan to?
yeah, so it basically would be a 3% increase across the board there.
With the ortho removed?
With the ortho removed, yes, on the retirees. Right. Again, the rates, even though we're removing the ortho, they were just trying to figure out any way to create any stability. I can't tell you that moving from a 60% to a 50% on basic is gonna do a whole lot. I don't know if that's gonna be enough to drive people to the high plan. Like I said, more than half of your folks are on the low plan because they're so closely related.
No, we got a 2-year rate guarantee.
But it does last 2 years.
That's what I'm saying.
We take the 3%
I mean, if
increase.
they're offering it, they know the risk they're taking.
You're right.
So I say, done.
The
Okay.
2-year rate
Could
guarantee.
you not negotiate 40% for Entra on the low? Because everything else is 40% except regular, so maybe you could go down to that.
Say that again, Ms. Kay.
Instead of 50% on your low.
On the basic and
On the
regular?
ortho.
What exactly does that
Retirees
go down to
and
40?
active retirees.
Oh,
Active and retired. Give it at 50%.
Is there a motion from anyone? Which we should have had before discussion. Ms. Carroll?
The discussion is open.
No, discussion shouldn't have started until we had a motion on the floor.
Well, I move that right now that we're presently looking at all these options 1, 2, and 3. And,
That they renegotiate.
yes,
come back to us.
renegotiate, yes. Especially option 2. I prefer to see a little change in option 2.
Do you have the time to do that? And
Like next week.
since we're this deep in it, I mean, Dina has all of the information, so I could probably, whatever you guys tell me to go back with, if you want me to reduce see if we can move the ortho to 40, if you want me to look at,
On the
throw
low
this
side,
out there
right?
again,
On the low side, right?
on the low.
Yes.
Yeah, we'd leave the high, I don't think we mess with the high plan.
Because those moms of those young.
On the low plan, the things that I think could potentially have impact would be reducing you could reduce the basic to 40%. Again,
I don't agree with that either.
okay, I'm throwing out options.
It's just that,
You guys are here to tell me
you're
yes or
saying
no.
the major expense
Okay,
is Onthro, and it's the same percentage on high and low, so why not lower 10% on the low end?
even if they give us a fraction of a point, then, I mean, that's something.
Anything would help.
and you have a
But here's-
2-year guarantee,
It's a
right?
2-year guarantee.
But here's the thing, is what I'm thinking, is that if they lower it to 40%, then I would expect a decrease in the premium cost. Because
15
they're already saying this is what we're gonna do.
Yes.
So if if the two don't go together,
Yeah.
then
agree.
we're back to here.
Right, no, we
Okay.
we're
Yes.
same
So that's what I'll
page.
do.
I agree.
So do you guys want, I've heard it, you want me to go back and ask for 40% on the ortho and see if they'll give us
The rest of the
anything back?
Well, and let me just say this, and I'm probably the newest person on the committee, so I probably really should be sitting back and not just observing,
No, you should be
right?
speaking up.
But my thing is, okay, and we've had this insurance since, I've been employed for 28 years. We've had the entire time. And with whomever it was with,
Yeah.
you know, we didn't care who it was with, we just needed the insurance. And so, you know, I'm feeling like regardless of your position that you're in, whether you're active or you're retired, whether you're a custodian or whether you're a retired superintendent, you know, you're gonna be fine with stomaching a 50-cent increase, or for the family, $1 increase. I mean, that's not gonna change whether you're gonna be able to go
That's correct.
buy a piece of chicken or a piece of steak. You don't go to the casino if you're retired. So, you know, I mean, I don't have a problem with the increase and the 10%. It's just if things change, and then again, are you splitting hairs to say, well, we're gonna drop to 40% and we're gonna take 20 cents off? And then if you do that, but then at the end, but if you need that insurance, that 20 cents you just saved every month is gonna cost you $250
Right.
Yeah.
for those, or whatever. I mean, I'm making up numbers, but
No.
I hope you understand
No,
what
that's
I'm
totally
saying.
fine.
Yeah.
I do, I think if we said, if it got us 1% or better,
I'm fine with that.
that would, I'm not trying to make a motion, I'm saying if they would give us 1% from taking it from 50 to 40, I think that's probably worth it to do it.
And
You're saying a 1% increase as opposed to a 3%?
No, if they dropped it from a 3 to a 2, if they gave us 1% or
But how much money are we talking about? Like if we do that, just, if we
10%
can just
of
talk
the
numbers.
340, so 34 cents.
Okay, so for 34 cents and we drop to 40, I don't want to do that.
Okay.
Because
Yeah.
and this is my opinion simply, because if I have a child who needs
That's
braces
it.
and that 34 cents that I'm gonna save is not gonna match up to the $200 or $300 that I'm gonna have to pay if I need the braces. Am I understanding?
What
or am I
I'm hearing
really
you say,
understanding?
what I'm hearing
Yes.
is you're more than willing to pay that extra 34
30
cents
cents.
to get the bigger benefit when you go for the
That's
braces.
what I thought.
I don't
Push
think, yeah,
children.
I agree, the numbers
That's what you
don't
said.
make
You want it to
sense.
stay at
30 cents doesn't save you the 10%.
Can we please have someone make a motion so we can give these gentlemen direction from the committee? Is the.
I make a motion that we go with option 2.
Okay,
As is.
thank you
Yeah,
so much, Mr.
I would
Stanford.
second that.
And Keith, thank you, Keith.
And we're keeping it at 50% on
Yeah.
the loan retiree?
Based on what I'm hearing, yes.
So that is, any more discussion?
No.
All those in favor?
Uh,
Opposed? There you direction.
And I promise you, if we can get any more discount, if we can discount it anymore, it'll be on.
Yeah, I just think I'd rather save $300 than 34 cents.
And we're locked in for 2 years, so
That's all.
a couple years we can look at it again and see how we're doing.
Okay.
Hopefully they don't come back this time and say, what, 15% now? But, I mean, we'll cross that bridge when we get there.
Now if they kick me in the face, that's just a long way.
What was the contract that you all got 100% commission on?
Trust
But I'm
me.
fighting for those who are.
Do you need any explanation on
No.
why we do that?
No,
Okay.
I know, I just wanted to know which one it was.
All right. So moving forward, the next thing I want to talk about are, let me do this. I'm going to go ahead and skip. I want to go ahead and talk about open enrollment. I said skip, I wasn't talking about you. Talk about open enrollment, some things that are going to go there, and then we're going to go back and we're going to talk about new product offerings, and that's where I'll let John speak a little
It's
bit.
5 to 7, just time.
So, okay, so open enrollment, so this year we've decided that we are going to offer a self-service enrollment option. So what that means is that 2 weeks before we show up to do on-site one-on-one, we will send out a link to all employees, and they will have a 1-week window to go out and say, I don't want to make any changes, or I just need to change my dental to employee only, or I need to add a spouse, or whatever those changes are. At the end of that week, this was my decision, there was a lot of discussion about this. I decided that I wanted to stop the self-service enrollment after 1 week, and then that gives us an opportunity to assess how many people did we actually have do self-service, and then I can say, then it's easier for me to schedule and say, okay, instead of having 5 people go to whatever school, now I only need 2 people at that school. And then what we will do is we'll see everybody else one-on-one. When we get to the last week of enrollment, we will send that link out again, and we will say, these are the schools where we are still scheduled to go this week. If we've already been to your school, you can either come to one of those schools, or you can go to the link and self-service enroll, okay?
And the self-service enrollment, which is optional,
Yes.
how will they get information such as Dina Demos?
Yeah, so all of that is built in. So there's it'll basically be reading. So they'll have a screen and it'll tell them, it'll explain what the changes are, and it'll say the low option has changed to 50% on the basic. It'll have all that information. So there will be some reading, some script to read, and then they'll make their decision. And we'll highlight, and we always do that in our benefit guide. But any changes, we'll make that really bold and highlight it, so we say, attention, low plan is changing, or whatever. We'll
Are
make sure
there
to do
any
that.
things you're offering that other than the standard commission?
Sorry, say that again.
Is there anything you're offering to employees that will generate you anything other than a standard commission?
No. You're talking about
So the trust mark wasn't enough?
Trustmark. So what we do there, I think we should probably explain a little bit.
You can, so you have the
Or
ability.
we don't have to.
Yeah, I mean, here's the deal. As in the insurance world, you have the ability to take heap commissions, or you can take level commissions. So what happens is we have a lot of open of enrollment costs. We have enrollers that are here. We have all the travel costs, all the hotel rooms, everything that
I
they're doing.
understand.
Well, but I want to make sure that we do go through that because there's all those costs that are upfront costs immediately. So in some cases, we need to have rather than take a payout of 25% level or 30% level on life insurance, we'd rather take 100% the first year and we get 5% or 3% trail thereafter. Now, it's not great in the long run, but what it does is it gives us the money at that point in time to be able to facilitate the enrollment.
I fully understand.
Every enrollment firm, every broker does the same thing to where you're trying to weigh out, do I take the heap commissions or do I take the level? And we try to blend it so that we've got a sustainable stream of revenue.
Which is why it was perplexing that we were told as a committee that one of the reasons we should not do an RFP was so you could recoup your investment.
We didn't tell you that though.
But that's what it was told to us.
Yeah.
Say that again, I don't know, what is it again? We did what? We said something?
No, you didn't say that.
Oh, I'm sorry, okay, I thought we'd said that. Okay.
This committee was told that one of the reasons we shouldn't do an RFP was so you could recoup your investment, but you had already gotten 100% commission to do just what you said, to pay for the enrollers, to pay for the hotels, to do all that.
Well,
So
and I'll tell you, Ms. Mounts, our business is a very tough business. There's a reason there's only about 3 of us that play in the school market, and it's because we don't have health insurance revenue. Health insurance revenue does this, and it's big. And so, but we don't have health insurance revenue, we have ancillary product commission revenue. And so that revenue does this, and then it kind of goes down like that, to where we are the next year, we're having the same cost the next year that we had this last year.
And you assured
Those
us
costs
that
don't
you
go
were not
away.
interested in the health insurance end.
Yeah, I'm making that as a point of reference, that we don't have ancillary benefits and health insurance. That's why the Andrews rep was saying that they needed health insurance and the voluntary benefits because they didn't think they could financially swing doing the enrollment. It's a legitimate concern.
All right, anything else?
Okay.
About open enrollment?
Okay, so this year, last open enrollment, we used the school's substitutes, if you will, and I think we actually even had some feedback that didn't work out so well. So what we've decided to do is we're going to take that responsibility. We paid for the subs last year. We've decided that we are going to contract, and right now it looks like that we're going to work with Lofton. They're a local Lofton staffing agency, and we're going to hire. We're going to do all the background screens and all that. And I think they actually have to come up here for some of that screening to make them eligible to work in the schools.
So these won't be your employees?
These will be folk. They won't be our employees to come do the substitute, but we will be able to. They will be they'll be contract employees that we will lead. So if they mess up in a school, we can send them home and get somebody else.
Okay, so let me clarify. So they will be coming into my building as they're not official LPSS substitutes,
Well, they'll have
and
to
they
be,
would be going into my classrooms?
Yes.
they will have to
And,
be vetted by HR, just to sit while the teacher goes at.
and so for my particular school, we work like a charm. Every person that has come, since we've been doing open enrollment in there, they've said, this is awesome, this is great. I give them a schedule, we have blocks on there, my people know what to do, they know, I mean, we've done this, like, we're good at it, just to, but, I just don't know how comfortable I am.
Well, I'll tell you what happened
With
last year.
people who are not subs, because let me tell you why. I can call the subs that I know that regularly come to my campus. They know our kids, they know our teachers, they know our routines, they know our schedule, they know it all. I don't think it works that way. From what you're saying, it doesn't sound like it works that way. Maybe at a large school, they would have more of a problem.
Well, we had the principals deploying them for other things and not putting them in the classroom. That was
We
the
had a
problem.
lot.
But maybe
Then that
instead
sounds
of
more
just
like a-
wiping it out.
Yeah, that sounds more like a conversation to have with principals.
Yeah.
Well, we'll talk about it.
Okay. All right.
We will. When is y'all's next principals association meeting?
We usually have them before we have the meetings here, about an hour before.
Can maybe we come just for a little while? I can and get some feedback from you?
Yeah, contact Jeff.
Jeff Devitas?
No, not Jeff Devitas, Jeff.
Jeanette.
Yes,
Okay.
he does the, he does the agenda.
And we're open to whatever works for your
Sure.
schools. We're just trying to.
I'm just thinking, because we've done this a few times, like, I'd be more comfortable with my students having people that I know
Your
there.
subs, yeah.
Yeah,
Completely
and my regular subs.
Skip will continue doing what he does, and that's going out before the benefit consultants show up, and he will talk to the point of contact at each location, whether that is the principal and the administrative assistant or a person that's working in the front. One of those people, he usually tries to talk to both of those, so we'll do that again. This year, right after open enrollment, we built a portal, an employee benefits portal. It's out there, but not everybody knows a lot about it right now. So we're going to make a real effort to drive people to that. They can get all their forms, their claim forms. They can get all of the information about their policies. It actually has an app that they can put on their phone to get to that. One of the things that we're going to do is we're creating just small, like business card size magnets, and we'll give those to everybody. And it'll have our one phone number to call for customer service. It'll have that the information of how to get to the portal. On-site meetings begin on Monday, the 16th of September, and will end on November 15th, right?
Right.
November 15th is it. What else on that? I think that's it on open enrollment. So as far as new product, one thing that I did come in and meet with Mona and her team, I guess it's probably been a few weeks, maybe a month ago, to talk about the logistics. One of the things that we didn't bring in last year because of the changeover and all that was a hospital indemnity plan. Okay, it's a standard in most of the cases where most of the groups that we work in. That's what you see here, the Aflac plan. Now I know that on your health plan, I don't know all the details on your health plan, but I do know that you guys did just get an increase on the max out of pocket, and that just went into effect. How this impacts that, it could impact that. Let me tell you how this type of plan works. So if somebody is hospitalized, it'll pay them $1,000 immediately, okay? And it pays directly to them. Each day that they're in the hospital, it'll pay $100. Maternity is covered. So the good thing about Aflac is they've built us a plan that has no pre-ex. So your folks that are already pregnant, they can still get the policy. And it'll be covered as long as they don't have the baby before January 1st of 20.
The concern I have about this is I would prefer, rather than you identify that, offer this to people next week or in the next couple of weeks. I don't know how this interfaces with what Lynn Fontaine has.
I'll tell you, it doesn't impact. So this is a standalone voluntary policy. But on your basic plan, you have a $950 deductible. On your enhanced plan, you have an $800 deductible. That $1,000 could give people a lot of, they could feel pretty good. If they have to go to the hospital, they don't have to come up with that.
I just have a concern about mixing voluntary
It's not mixing.
with health and
Yep.
educating employees that this is not a health plan, but it says it's a hospital plan.
Yeah.
So
And we already have like critical illness and some of the others that do similar stuff.
I mean, that's what
Your
a
cancer plan, Ms.
yeah.
Mount, your cancer, people buy the cancer policy, they're gonna get a big volume of reimbursement from the plan that Lynn does, your health insurance.
correct.
But the benefits that come from their voluntary cancer policy are paid directly to them and don't interact at all with the monies that Blue Cross are submitting.
Is this for just active employees?
Yes.
Is this similar to what we used to be able to purchase that we refer to as disability insurance?
But you still have disability option. That's through Lincoln. Yeah.
Because I remember.
So your disability, basically what that does is it protects your income. So if you can't work and you don't have income coming in, disability will
Because disability
supplement.
used to cover maternity.
Yes.
Yeah, and it still does.
And any
It
hospital.
still does.
Yes.
The
Whatever.
difference is protecting your income versus helping you pay your bills.
Okay.
I would feel comfortable if you don't mind calling Lynn and just telling them you plan to offer this.
That's fine.
Absolutely.
That's fine. I actually asked him before we got started, just to make sure I had the numbers right on the deductible, but I can do that. Now we'll go ahead and move. John has been doing a lot of work to try to find some options for retirees. And I know we're short on time, so John will keep this at a high level, but I think it's more, we want to, and we told you guys this when we first came in. We are not the typical broker in that we like to step outside the box and get creative with our plan designs. We want to look for things that the other broker's not going to be thinking about. They're not always thinking about the retirees. So John has done some work, quite a bit of work, and I'll just let him share that with you.
And honestly, a lot of these, we just got the offer. So there's a couple of options, and really the point of this is there's other plans out there. I just really need to know exactly what it is y'all are looking for. This is specific to retirees, which I know that is a separate meeting, but at the same time in our meeting, what I said was, I would like to try to see if I couldn't get some benefits for retirees, because retirees can't participate in the active employee policies. And so for those retirees that have the Unum long-term care policy, keep it. I want everybody to hear it. I have gone through and looked at that policy, and I will tell you right now, you can't get those those are hard to come by. Retirees can't get it anymore. There are some cases that you
Joining
can
up annually.
Real quick, I do want to tell you, it is a rate hold this year.
Okay, good.
Yes, so that's always makes you feel better, but you know, the thing about that Unum policy, when I looked at it, so my brother and I bought a long-term care policy. My dad died when we were in college. We bought a long-term care policy on my mom, and that policy kept on going up. My mom passed away before she was in nursing home long enough for it to pay, so we got nothing. But we had that just in case, take care of it. So what I look at is on your Unum policy, it appears from what I'm reading and what I've gone through and we've asked, and I always kind of caveat that, they can't raise the rates on your policy unless they raise it on the block of business, okay? So that means is they can't just specifically pick out 65-year-olds or Lafayette school employees. They look at the block of business that they have, and then they raise the rates on that block. So as long as that block of business is running good, just like your health insurance, premiums in, claims out, do they need to give a rate increase? They have to get it approved to get a rate increase. So right now, what I'm looking at is you've got option A, B, and C, which are amounts of monthly benefit that it pays. And then it also goes in the duration, whether it's 3 years, 4 years, or I think 6 years. Well, I will tell you right now, that's a great plan. The design is really good. The premiums are really good. Unum is a solid company. They're not going anywhere. What I said before was long-term care policies that we've seen out there, they have dwindled away because a lot of those companies have gone out of business. Unum is not one of those companies. Unum is a solid company.
But their premiums have almost doubled.
Yes, ma'am. And the sad thing is, those premiums almost doubling are still cheaper than you can get it out in the market anywhere.
I do understand.
That means, you see what I'm saying? Is so my thing is, as much as I'm telling y'all, that is a good policy. Hold on to that policy. If something else better comes along, we're gonna tell you. But right now, I'm keeping that policy. So that's as to the Unum policy that's out there right now. We're looking at possibilities of is there any way we can reinstate it? Can we bring it back? What do we need to do? But I know is, it will not be offered to retirees. So what I know is most carriers don't want to offer plans to retirees because of the age requirement, and it's the rate. So what we looked at was, what are a couple of things that I can do that don't necessarily have to be payroll deducted? Now, a little unique situation in Louisiana because you can have it taken out of your teacher retirement from a payroll deduction. So that gives us a little more flexibility. But in some cases, if that's not the case, I need something that I could actually have drafted out of my checking account so that I have the flexibility to not be tied to that. So one of the products that we looked at is this. It's called Guaranteed Trust. It's a Guaranteed Trust Life. And so this life insurance company is an A- rated company. Okay, so A and best, A-, which means excellent. That's, I think, 3 from the very top. And the whole idea behind this is a short-term home health care policy. So the idea behind this is if you go home and you are treated by a nurse or you're treated by a licensed home health care practitioner, it will pay a specific daily benefit if you're under that care. And they've got different rating factors that they do. The one thing I can tell you is this. We drew up this little chart here that kind of tells us what your Unum premiums are. I want to know is if I'm 50, what's the monthly premium? 55, 60, 65, 70. So that's where these premiums break out. What I look at on the home health care policy here is that the premiums fall right in line, and the older you get, the cheaper they are. Okay? The reason is this is not near as rich a benefit as the Unum policy. Whole different animal here. But what I'm trying to do is I'm trying to find options to where y'all look at it and you go, you know what, I may be interested in that. Because what I may want to do is, if I can get a plan that pays me $150 a day, if I am being taken care of at home, then that means $150 a day, 30 days, $4,500 a month. I think that's my math right. It pays that up to 1 year. At the end of 1 year, it's done. So it's only a 1 year benefit, and it only applies to home health care benefit. But if I'm 55 years old, it's $15 a month. If I'm 60, it's $22 a month. If I'm 65, it's $25 a month. If I'm 33,
Yeah, I don't have any.
I've got to get it. I just got the rates. This is how soon
You
this
want me to make
is.
copies?
So what I'm going to do is I'm going to have this. I'm going to have this right here, and then I'm going to have right beside the Unum rates. I'm going to put these rates, and then I'll put the other product rates so that you can see them compared side by side. Does that make sense?
Yeah, and I
Okay.
think the retired teacher meeting, Carol, is September the 9th, the next meeting.
I don't know the exact date.
If y'all can get that to Mona or get that to us,
It's September the 9th.
okay, one of us will be here and would love to, I will try to get some material. Like I said, I would like to get it to you in advance so that you can look at it and go, man, this doesn't make sense. So make this a little bit easier to understand, because I do make things very difficult, and I know that.
John,
But, go ahead.
because I don't want to lose my train of thought, the underwriting behind this, how do they qualify? If someone
So
says,
they're gonna ask very simple questions, and then to where you get approved or you don't get approved. It's not a very tedious process. This is not a long application. When I had to fill out my mom's long-term care policy, it was a unbelievable application process. This is about 5 questions. It's not a very difficult process. I will have those questions and I'll attach those to these so that you'll know what those questions are. The next one is this, and then I'm done, and they don't have to listen to me anymore. So, Trustmark, which is the same company that offers the life insurance policy and the universal life events policy, I went to them, they're based in Chicago or north of Chicago, I went to them and asked if they would create a special policy for the retirees of Lafayette Parish school system. And they did. So this is a pilot program. Nobody else has it. Nobody else has ever asked for it before. This is the first time that they've offered it, and they're going to do it to see how it works. They want to see if there's interest in it. They want to see what kind of participation they get, to whether or not they're going to offer it to other Louisiana school districts. So this is
Life insurance?
This is life insurance and long-term care.
I thought we were told last year, when we got rid of the life insurance for retirees, that we couldn't get, that nobody would write our life insurance.
So
I'm just,
nobody will,
Nobody will.
except they will. So that's what I'm saying. This is not something, this is the first time they've ever done it. This insurance company's done it. So the policy, if you get the policy, it's guaranteed to 100. The premium is guaranteed until
This is
100.
a pilot program.
Yes, ma'am.
They're not gonna, like, if it's not working well, they're not gonna say, oh, well, we're not gonna insure you.
Their individual life insurance policies, once you get it, it's yours. They cannot raise the rates. It's guaranteed to age 100. They cannot change the premiums, period. So even if they don't like it,
unless it's going to be.
unlike a group insurance policy.
It's Trustmark. It's
Trustmark. Unlike a group
That means
insurance.
like it doesn't
You're pretty-
exist. I know nothing.
You're pretty safe with
But my
Trustmark.
thing is this, just like a group insurance policy, they can always raise the rates. Your Unum long-term care is a group policy. This is an individual life insurance policy. Once you buy it, you got it. They can't raise the rates, they can't cancel it, they can't reduce your life insurance. So the way this works is the same as the policy that we have in here, in that I buy a life insurance policy. I buy a $100,000 life. So my death benefit I buy is a $100,000 death benefit. They are going to pay if I can't perform 2 activities of daily living. which is what your long-term care policy with Unum says. It's the same standard. If I can't bathe myself and feed myself, if I'm in a nursing care, if I'm in a home health care, it doesn't matter. If I am having to be assisted to perform 2 ADLs, after 90 days, they will pay 4% of the death benefit for 4 years, 50 months. So 48 months and 4 years and 2 months. So what happens is this. I have a $100,000 life insurance policy. They're going to pay me $4,000 a month for 4 years, as long as I am receiving nursing assistance or home health care. It's a long-term care policy. If, though, I'm like my mother, who's in a nursing home, but she didn't make it to the 90th day, she made it to about the 75th day.
Right.
And she died. And my brother and I got nothing. Zero. Nada. Because we bought a long-term care policy, not a life insurance policy. I get both sides here. It's a life insurance policy with a $100,000 death benefit. It's a long-term care policy that pays $4,000 a month if I buy $100,000.
Yeah, but
So the premium.
The premium is unbelievably high.
ridiculous.
But I will say, have you priced if you went out to the marketplace to look at long-term care? Yeah, it's,
Yes, you're right.
So my thing is, the premium, that is a weekly rate.
Yes.
I have to convert this to a monthly rate. That is a high premium. But my thing is this, go online and get an individual life insurance quote. And see and here's the thing, on this one, I've got the questions that you have to answer.
I can't
Right
see
here.
the Chinese looking at this at all.
And it may be, here's the thing is, it may be something that it doesn't make sense. But here are the questions that you have to answer right here. It's very simple, and they guarantee a 5-day turnaround to whether you're approved or not approved. That's it. And that's on a $100,000 max. You can get 10,000, 20,000, 30,000, 40, 50, 60, 70. But the thing about it is, as expensive as it is, a lot of folks might be able to can't afford a $100,000 policy.
Well,
But if I'm a retiree and I don't have an option to get life insurance at an easy
You're
way,
asking me to pay $400-something for $100,000, and I know I have that, and I'm not paying near that cost.
if you bought it earlier, you locked it in at a great rate. This is not for somebody that has the Unum long-term care policy. This is not for them. This is for somebody that doesn't have anything and wants an option. That's the only reason
my
that
suggestion
It's an option.
is to get a sense of whether or not there's any interest, which is what you're asking. Is that Carol and Butch, if he's available to go, can show those to the retirees and report
The
back to
minute I
them.
give this to them, I'm just telling you.
but you might be surprised though.
Is that weekly or is that monthly?
Let me ask you this though, what if there's that person out there that has a little bit of money set aside and they just got
I already have it.
they just got diagnosed with something
Okay.
and they've been given 6 months to live, 3 months to live, and they can get life insurance for less than what that little nest egg
it would
is.
depend on them. Here's the thing,
It's a situation.
let me convert this to a monthly premium, number one, so that they can see monthly what this number is. I just didn't have time to convert
Weekly
it
is
monthly.
kind of high enough.
Yes,
It was?
it is.
Oh, no,
It is.
I'm with you 100%. My thing
We
is,
know.
it's an option. They've never done it before, but when I said, can you try something?
Appreciate
Let's
that.
try it.
Yeah.
Appreciate you doing it.
Yes, I
And
appreciate
Carol can
that.
get some feedback.
I fully understand this.
Okay, and I'll get this, Miss Carol, I'll get this to where it's easy to read.
One more thing now before we adjourn. There was a lot of talk about the survey that was done post-enrollment. We have no data that I know of at the end of the year, so we have information not only on how we did with enrollment, but how we did with the selections of the policies, how we did with claims, and were they handled properly and timely. Would it be possible, it's the start of the school year, by the end of the school year, for you to have some kind of instrument developed? Not that you develop.
And then, no, what I want to offer is and I forgot to put it in what I told you guys. We do that survey not only for us, we do it for you. So whatever you tell us, if you want us to say, have you had any claims this year? Were they paid quick? Whatever you want in that survey, she doesn't have to go create a new one. We can do that. So that's your instrument.
But you're the vendor.
You tell me what questions you want in there. I'll give you access to the results. It's that easy.
Come on.
Okay.
Do you want,
You want it at the end of the school year?
Wouldn't you think? I mean, that
That's
would be by
fine.
the time the claims are done.
Then that
Well,
gives
we
me time,
don't
yes,
want
the answer is
right
yes.
after we
It's- We can
purchase.
do it.
Yeah, and that's the comment. You don't want it right after you purchase it,
Right.
and you
You
have
want
no
time
idea
to
what you
experience.
have. So I would just hope, since we've not done this before, it's something several people have asked about. So if we could have something at the end of this school year, and you and I can talk about how it's sent out, whether it's done via email,
We can do a Google form.
or however it's done, so we can get the data, and we can have that on an annual basis going forward.
And as you think of questions, send them to me, I'll start compiling.
Okay, anybody, if you end up with questions, just send them to me.
Ms. Mounts, one thing to keep in mind with the way the school systems are set up, a lot of folks will utilize these programs, their wellness benefits in these plans. And a lot of them, I know my wife was one of the retired school teachers, she always scheduled her wellness in the summer months, things like that. So might want to allow a little time to make sure, I think that's when you're going to get a spike in usage on their wellness claims because they have more
It
time.
always is. Our health insurance always spikes in the summer.
That would be something, so if we can tag it at the end of the school year, but you might want to build in a little extra time to pick up those claims and that usage to see how those claims were paid, specifically the wellness claims in the summer months. Something to think about.
Any more questions, comments? Thank you very much.
Thanks for having us, sir.
Meeting's adjourned. Oh, we have a motion, we have a second.
Oh, second. Movement.
All those in favor? Thank y'all for staying so late.